What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. That sounds like something you're interested in. Consider subscribing, as I do provide daily updates as well on Twitter at Hemi137, and soon to have current events on this particular channel. So, with that being said, as per the usual, we're going to go ahead and throw this bad boy up there and give us a little bit of a recap over the last week. Now, for the past couple weeks before coming into this past week, there really hasn't been a lot going on. The market has been waiting for earnings, and something I've always hinted to or pointed to is that earnings is where you're going to essentially get the most information out of essentially any time out of the cycles, because of the fact that at this point a lot of information is guarded, as the Fed, as the administration are trying to not cause panic or a crash in the market. So to prevent that, they will not disclose information until they absolutely have to, and ultimately, knowing how the algorithms work, they will do revisions on data multiple times after the fact, as that doesn't have revisions don't have an impact on markets. It is headline news, and the longer you are in the market, the longer you will be mindful of that. So with that being said, let's just go ahead and get right into this previous week, because this previous week is starting to kick that off. We are now reporting Q3 earnings as we step into Q4 here. And again, something I've always stated: when you first come into earnings cycle, the first couple weeks are going to be important, as those are the industry leaders. The market will make its decision from that point and then determine where it's going to go after the fact. It doesn't deter from the fact that, for the next 3 months, till we start Q1 again, and report Q4 earnings, we'll have earnings all throughout the next 3 months throughout that time. But again, the bulk of what the market's going to go off of is that first couple weeks. And as of right now, I think we're essentially targeting October 2nd is Apple earnings. And that, I think, is going to be the day essentially where the market will determine which direction it's going to go. Now, on the back end of that, we also do have essentially government shutdown right around that time as well. So you have to keep in mind with that. We would be the second month in student loan repayment. So those are other things you have to consider when going on. And right around that same time, you're also going to have monetary policy. Now, monetary policy has been fluctuating a lot because of the fact of the different data. And something I said, especially when you have a huge gap between monetary policies, it will change a lot, just determining on what's going on. And now that we are going to get a lot of earnings before the next monetary policy, that will really dictate how things will be if we are officially in a pause. Now, if we don't, there is two more monetary policies. So if we don't get one here in November, there's the odds of potentially December. But I think if we don't increase rates, which you're saying, they're hinting that there should be at least one more in these next two that are going to occur. But it really just depends on how the market is handling that. And that's why, again, going into this earnings is going to be important, because it's going to dictate if there will be any kind of a monetary adjustment here in the next the last two we have before the end of the year, as this will be the last earnings cycle before they're going to report Q4 earnings in Q1 of next year. So just something to keep in mind. So over the past week, to get this all set up and try to essentially establish the infrastructure here, so we can start talking about this previous week. Again, one of the biggest things that we were looking for this week was essentially the core CPI. And bank earnings were the big ones that we're really looking at this past week. And so the core CPI, we were expecting 3.7, and we got 3.7. So again, not a good sign. as headline inflation did come down a little bit, but you have to understand this is the sticky part. They're talking about inflation, and it's annoying because of the fact that, since this all started back in March, it's just March of 22 as we started increasing rates. So trying to combat inflation. So essentially, since then, it's been an 18% increase in car insurance, 10% increase in car repair, uh, transportation up 9.1, rent inflation up 7.4, home inflation 7.1. Food away from home is at 6.0. Again, you have to understand this is that hidden tax, and this is why inflation, and people don't see this because you have to understand the average consumer, the average American, they look at monthly payments. And so when you are looking at a home and when you are looking at a car, the two essentially the basic necessities that you need to be able to essentially just live your life, unless you live in a in a city where you have easy access to transportation, which even transportation is high as well. So anything you're essentially touching is going to be high. But all these little incremental changes add up, and so it's taking a huge chunk out of what was just super. It seems like super cheap compared to prices now, just a couple of years ago. So with that being said, again, it all started again from it was happening before the pandemic happened, and then the pandemic happened, and then the printing of the money supply obviously is just throwing things way out of whack, and now we're just at a increasingly uh, ridiculous rate, a burn rate in which we are currently spending right now. So, with all that being said, you're seeing high inflation, and things are becoming sticky, and they're not going down to that 2% that the Fed are aiming for. And I'm not sure it ever actually will get to that point again, considering their burn rates. Now, something I really haven't talked about because I don't like to project too far out, but there's a lot of whispers that this may actually be the last cycle in which the dollars will be dominant and could exchange hands. And now we've been well aware of that with everything that's going on with BRICS, as they are trying to offload the dollar and get rid of the dollar being so dominant, because the U.S. has essentially weaponized the dollar to essentially combat oil prices, because OPEC has been raising oil prices ridiculously. So the U.S. doesn't like that, and them raising prices is ultimately inflating a lot of cost on a lot of different things, and the consumer will always pay for that. And so again, going over the fact that we are, I talked about last week about how we only had so much oil reserves, and then we also had the fallout in Israel going on, and that whole area around there is all about the resources and oil, and that's what this is, I think, ultimately about, because there's a lot of other whispers that you're hearing about different countries being involved and everything else, and I ultimately believe, the underlying sediment of what's going on, and that's kind of what I talk about a lot on this channel, is what is going on in that area around the oil. Right, this is a battle for the oil. Oil will always be dominant for a very long time. It's not like we just roll off and start riding EVs and that's the end of it. It's not that simple. It's had a stranglehold on the economy for a very long time and will continue to hold for quite a while. So even with that being said, inflation is high, and again, the report is still showing that. So again, every month it's going to start being a topic of concern if inflation continues to start running up. The last thing we want is it to start skyrocketing. It's going to put a lot of pressure on the Fed to do something about it. Can they continue to push rates higher? There's even an article that came out this week, essentially that real estate agents and stuff are complaining that they don't want the Fed to raise any more interest rates. Like they want them to start cutting because it's getting so bad that I think we actually peaked at 8%. I saw a headline saying 8% as far as home mortgages as of right now. So we're peaking at some pretty crazy numbers, and just nobody's going to buy at these, especially after seeing over the past couple of years, stuff down around like 3%, and now everything's up about 8. So you're paying 10x what you would have paid just a year or two ago. So it's absolutely absurd. And all that being said, now we're starting to get more people coming out, people doing walkouts, right? Now you have Walgreens employees getting prepared for nationwide walkout. And you had this with um, uh, GM, right? And yeah, and a bunch of other these companies are stepping forward. But the problem in FedEx, right? FedEx actually won, so I think that kind of kicked everything off as far as them striking and trying to get higher wages. Now, this is the problem, and I'm not trying to be nasty about this or anything, but you have to understand businesses are in this for profit. They are not in this to essentially look out for the employee. They are looking out for the business. This is why it is a business. And if they can't remain profitable, they can't afford to pay you ridiculous amounts of money. I understand that inflation is out of control. Completely understand. But on the same token, they have to remain profitable. And we are seeing this with different companies. You see this with McDonald's. McDonald's is one of the first ones you saw where people wanted $50 an hour. Sure, they won and they got it. They're working $50 an hour, but now they've automated just about every aspect of it. And now they're like fully automating complete stores because they don't have to pay for people to have time off. They don't have to pay um, pay for vacation time. They don't have to pay for any of these things. So now it's all automated. So sure, you can have your $15 an hour, but there's going to be very limited spots for people to actually be working. And this is going to end up across the board. Understand that it is unaffordable to do anything to live in general. People, and we saw this on the jobs report, that people are working at least 2 full-time jobs. And so you can't come in there and demand. Yes, I mean, ultimately, just now is not the time to be doing that. And when you hit bottom, you can't be demanding things when at this point they are looking to cut because they need expenses down because they're dealing with inflation as well. And they're trying to make things much more cost effective in however they can do that. If they got to essentially start automating and using AI and doing all these other different things, robotics, you have to remember robotics is a big thing too that is currently going on. So they can do all these other different things and cut their expenses way down than have to worry about an employee. And a lot of times, robotics or AI can work around the clock. Right, and they don't have to worry about labor laws or anything like that. So, again, Walgreens going to be the next victim of this, and they're just it's not going to be able to happen. Right, GM is still talking about this stuff because they can't do it. They can't give you $300,000 a year and only work 4 days a week. That's just not going to happen because they have to. There's no way they're going to be profitable. Again, you have to keep these things in mind. Again, I'm not going anything against people that want to strike, whatever. You have the right to do that, but you have to also understand the same token, these companies, they can't do it, or else the company won't exist, right? And so if they want to remain in the game, they're going to have to make an adjustment. And if that means offloading, human workers and replacing them with robots, well, then that's what they're going to have to do. Right, and we're seeing more and more of this as we continue to roll through these issues. So with that being said, there's a total of 182 corporate bankruptcies in the third quarter this year. 182. That's crazy, and that's just this far. I think it's going to get a lot worse. The Fed want it a lot worse. They want this to hit essentially small business a lot more and kill demand. And that's ultimately what we're looking for. Is we're looking for that wave that's going to force the Fed's hand. Obviously, that has not happened yet. And again, every earnings cycle is going to expose more and more, unless there's some headline news that just randomly drops that we're not aware of, that could essentially force that hand and make it an emergency rate cut. So we'll see what happens there. JB Diamond from JP Morgan came out and said, now may be most dangerous time world has seen in decades. Let that sink in. That's coming from the number one bank, the CEO out there saying that it's the most dangerous time. because he sees a lot of the books that are out there, and I'm sure this insolvency on regional banks that are going on, we're going to get more, we're going to lose more banks in general. The question is the Fed has been trying to um, essentially siphon it out slowly, as opposed to just, that's why they can't just keep laying on rates. This is all over, because if you overexpose, which we could already have done, we don't know because it's so delayed. It's going to hit like a ton of bricks when it does hit. And so that's what the Fed are kind of waiting and pumping the brakes on this, because they're waiting for that the delayed reaction to kick in. And when it kicks in, if you over tighten, it could be a huge problem, and then that could lead to emergency quantitative easing, because you killed demand so bad. But then a lot of times, again, you're dealing with a consumer confidence at that point, and where do they stand? Are they, so they spend all their savings and there's no way they can start spending, that they're going to need time to come back and recover? So that's what you're ultimately looking for. So again, we'll see what happens there, but that's what we currently got for over the past weeks. We are getting some really good information as of right now. This week is going to be exceptional. I think we're going to start getting a lot, plus everything going on with Israel in that stage. Again, there's talking about potential other events and threats around the globe and cities. So if something does happen there, be mindful that if there's any kind of terrorist event that occurs in the U.S., that could sink the market. That could potentially kill off demand quite rapidly, much like almost the pandemic, because it's a very black swan event, left field. People are afraid, don't know what's going on. It could reset. Well, all we're looking for is an event that is going to do a hard reset on uh, essentially all assets, right? All the stock market, all the housing. We need a hard reset to normalize pricing, so that we can start playing the cycle all over again for the next decade. We'll slowly grind back up again, then be in the same point we are now. And at that point, maybe we have CBDCs. I don't know. I don't condone CBDCs or anything like that, but nonetheless, that's what we're leading up to. I think we got another hard cycle, another 10-year cycle of this. And I am expecting a big boom cycle again out of this. But again, we need that hard reset. You can't keep pushing prices at what they already are, because then you start getting the hyperinflation, and then the dollar is going to be worth nothing, right? And then you'll be spending $1,000 will be your new $1 bill, right? Like that's how ridiculous it starts getting. So we don't want to start doing that, right? So we have to see what happens. But again, this upcoming week is going to be a big week. It's not going to be the Super Bowl week yet. I think that is next week. But as of this week, we do have the Fed Beige book, so it's going to start talking about what's going on up on the next Fed meeting. Get some insight into that. We are getting a lot of Fed members talking this week again. We've had a lot of Fed members talk last week. We'll get more of that this week. We will have Powell speaking on Thursday. Again, he's just speaking. I don't know how much of actual impact he has. He's been quite hawkish lately, so it'll be interesting to see if, again, anything comes of that. If it's a pre-recorded, again, or if it's just a blanket speech that really doesn't say a whole lot. Again, that's not going to have a lot of impact, only unless he's fielding questions. Will that have more of an impact on the market? More so because people are trying to catch him off guard. And when he gets caught off guard, he could say something that could turn the market. So again, anytime he speaks, you want to be aware of that particular date and time. So that will be on Thursday at 12 p.m. Eastern Standard Time. Upcoming events, monetary policies until the 1st, core until the 14th. We just had core, so, and then we are in earnings mode. So we are essentially in full-blown earnings mode at this point. We have Bank of America. We have Goldman Sachs on Tuesday. So again, more banks. Again, the top 10 banks, from what we've seen from Friday, are doing very well. It's expected, as they're holding tons of money. Even JPM, I think, is making, just off the interest in itself, is making billions upon billions of dollars, which is just absurd without actually ever doing anything, which is again very crazy and absurd to think about. But our top 10 banks, I'm not really expecting a lot from the top 10 banks. What I am expecting is potential downgrade because of what's been going on. That's been a threat that we've gotten. That's kind of what I'm looking for, the big 10 banks. But we'll see. Again, I think regionals, we're going to lose more regionals here this go around. Expect it until rates start coming down. Again, they bought bonds when it was super cheap, and then now they're underwater because of those bonds. So looking to see what other banks fold aside from the top 10. Again, if we lose a top 10 bank, that's going to just drive new fear. But I think the top 10 may be a little bit more stable as of right now, but it also, again, depends on the Fed. If they want to keep raising rates or they hold it higher for longer, that does just as much damage as if they keep increasing rates. So again, all strategically done. We did it at a rapid pace for a reason. We needed normalization fast. And so, again, you'll continue to watch things, historic numbers, very, very historic numbers. And at some point, it's going to snap. So again, on Tuesday, we're looking at banks. Wednesday, we start getting some big tech. We get Tesla, Netflix, ASML. So we got some chips going on. So that's going to be really important. Then we got also a Morgan Stanley. So Wednesday is going to be a big day this week. Obviously, Wednesdays are normally a big day with a lot of big earnings. So one big thing I want to point out for Wednesday is if you don't listen to any of the calls for earnings, Tesla is definitely one you want to listen to because Elon Musk gives a lot of great insight into the current market pulse. And every time he's essentially gone on these conference calls, he's given great insight and he's been correct. Again, he runs multiple companies. He's frontline that's going to tell you what's currently going on. And so if he's telling you that's he called essentially top on inflation, right? He called many different things. And so he even said if we increase rates another time, this was 2 rate increases ago, that things were going to have a hard landing. Right. And so, again, you're going to want to listen to that conference call just to get a current market pulse. Again, he gives good insight into that, onto what's currently going on. So that is probably one of the biggest things to watch this week, is to watch that or to listen to Elon and see what he says this week. Aside from that, again, they've done more price cuts on their vehicles. So they're just trying to get numbers up as they are essentially innovating the production of their vehicles to be much cheaper. So they are definitely taking advantage of the situation. And they set themselves up for that, right? And this is why they have an ecosystem. I talked about ecosystem a long time for certain companies, and the way they've built themselves out is pretty much almost indestructible in any market sentiment. So just why I like those particular companies. But anyway, on Thursday, we have TSMC. So we got semiconductors on Thursday. That's going to give us insight into what's going on with that for potential NVIDIA and how they may be playing out going into this earnings cycle. And then watch list, as always. So there's more upticks. So we're pricing in a lot more in the general index. Obviously, Tesla's going to be higher because it's reporting earnings this week. So this number will come down after Wednesday. So if you play Tesla, either you have to play it really early on Monday, or you're going to have to wait until after they report. And then after they report, you're going to see a huge adjustment in options. And it'll come way down or go way up, depending on what it does. Again, look over the past couple quarters. Tesla has barely been hitting expectation. You have to understand that it's not the Tesla of old, because we are in a recession and we're getting recessionary type numbers. Now, if we do really, really well and we blow expectations out of the water, we could just start ripping back up. At some point, that's going to happen. We don't know when that's going to happen. I still think that Q3 and Q4 are going to get a lot worse. And then we, at some point next year, we'll start seeing that reverse. But the recovery, we need the event to happen to where Fed's going to cut. And unless that happens, these rates are going to stay high and we're going to continue to get bad numbers. And then now you got everything going on with Israel, and that's essentially going to drive up prices, gas prices, and then that's going to again start playing into everything else. So you can see how there's a new event around every corner, and if it affects supply, it's going to affect the market. And so BA is starting to break down, and JPM is obviously come right down after they reported earnings. Then they're pretty much good to go. So that is pretty much that. Enough ranting. We're going to jump into some charts here. So as you can see, we've gotten some fear back this week a little bit. We did pop beginning of the week, then we started getting some fear again with what was going on. I think this is more just a recovery from all this selling that we've had ever since Powell was pretty much saying that we're going to have some sort of recession. Now they're talking about a mild recession again, saying they bounce back between mild recession and a soft landing. We are in a recession, period. You can define it however you want. It's more so almost teetering on a depression at this point, as the whole world in general is in a very, very bad state. And then we got a bunch of wars that are currently going on, which essentially can help us, and is historically shown that it helps pull us out of any of those depressions and everything, because you're looking for the circulation of money, you're looking for GDP to excel, and it does so when you start wars. So considering that there's two going on as of right now, we will see what happens from that point. And again, something I want to point out is there's been panic. There has been panic on getting more money to Ukraine. The billions of dollars we are giving them isn't enough, and there is panic that we need to start cutting other expenses to get more money to Ukraine. And I think that is ultimately because we need circulation of money. We need GDP growth. We need to quote unquote pretend, since we're in the middle of a quote unquote war, that these numbers still need to remain high. If we can't do that, we will be in trouble and the whole engine will seize up. And so there's panic there. So just be mindful of that too. We are very close for something to break. And we're seeing the panic in the administration. We're seeing the panic in the Fed on these things. So again, why I have this channel to point these things out. So SPX, we'll see what happens here. I do expect this to come back down to 4,200. Now, this is something I've always talked about. When you're looking at these charts, typically you get a major, this was a major support, and you got a hard, or you're going to get a big bounce out of it. The question is, this week we visit 4,200. That is the make or break level. If we break 4,200, I believe we will be going to new lows. So 4,200 is ultimately key here. This is also why we have staggered earnings, because of the fact that they are trying not to let all bad news come out at one time, because like I've stated, depending on timing can crash a market. If you get multiple bad events happen at one time, which we've seen this a couple months ago when we saw Apple and Amazon reported earnings back to back on the same week, and they did horribly wrong, and the amount of weight that they held, they gapped the market down overnight. And so these are the problems that they're trying to avoid. So now they're trying to stagger it a week. So if it starts selling off a little bit, it's not, you don't keep cascading into more bad events that essentially provide more fuel to the downside. So that's what they're trying to avoid from happening. So again, we'll see that is a key level there. Bulls, you want this thing back, essentially back over this level. This 4382 has been a strong level. It's attempted a couple different times, and it got hard rejected on Friday and just started selling off. So again, this week, if bulls want to reclaim this, they need to reclaim that level. That 4,400 level is something we need to break up above. Otherwise, 42 is where we're headed. And I think, again, it needs to hold. If it breaks 4,200, I think we are going to start pricing in a recession. And at that point, we could see some new lows. How low, I don't know. But again, it all depends on timing. I think if we do bad on this earnings and we get a lot of bad information, this thing could really start selling off heavy. So we will continue to watch and see how that does play out. Now let's take a look at Bitcoin. Bitcoin has been it's been grinding around here. Again, it's been very stable despite everything that's going on. It's been floating roughly between the 30 and the 25 for a very, very long time. So I really like the fact that it's doing this, as I do believe it's going to explode on the next big bull push that we do get. The spot ETF is going to make this thing go absolutely absurd, as it's going to essentially force institutions to have to buy Bitcoin. This is why there's been such a delay in a spot ETF for Bitcoin, because it's going to essentially force institutions to have to buy, and all that new money coming into Bitcoin is going to cause it to explode. So this is why I think it's still hovering as of right now, as a lot of people are trying to accumulate at this point. So I myself am trying to do the same thing as well. So I do like it as being a very stable asset as of right now. So we'll continue to watch Bitcoin moving forward. But if it breaks that 25, I think it can go lower. New lows, I don't know. If it breaks a new low for Bitcoin, it's not going to last very long, in my opinion. I think there's going to be a quick turnaround. It's something I've said. You're going to see a break of support to get liquidity before you get the big move. So again, would not surprise me if this thing does break below 20K for a short period of time to get liquidity before the big move up. And I'm thinking the same thing on equities market, that we will get one more big liquidity move down, and then it's going to explode, and then we're going to go into a new cycle. It's not going to shoot straight up like it has before. You have to understand we are in a recession, and that's not what you've seen in the pandemic. And a lot of people are have that falsified view of how the market's going to move, that's just going to explode straight out of there. It's not going to do that, right? Like, it's going to slowly grind. Once you normalize prices, confidence needs to come back, and so that confidence takes a while. So you're looking for a more slow and granular move up, as opposed to just vertical, right? Like we've seen with the quantitative easing when the pandemic hit, right? It was just print 40% of the money supply because the market was crashing, and then the market just shot up for 2 straight years. And now we're seeing what happens at the back end of that. So anyway, I'm watching this very closely, but watching those key levels there. I do want to take a quick look at oil. It's good to involve this as well, considering everything that's currently going on. And did touch back at 95. I guess again starting to climb back up. So see if it can hold this 83 level. Again, it needs to break the 95. If it breaks that, I think this thing is really, with the war and everything going on, this thing's going to be well into 100. I think at some point. How far? People are saying 150. I think some of these expectations are kind of crazy, but you never know, right? It's the markets. Anything's going to happen. It could just die off as well. But you definitely want to be watching oil very closely and determining what's going on, especially given, and this is why I flip between some different key indicators, just given the current market sentiment, because some things matter more than others, right? And like the bonds are getting absolutely crushed right now. Right, and we haven't seen a huge bond move like this, where things have just been crushed so bad that you have to look at it on the monthly to be able to see how bad this thing's been crushed, right? And so it's just massive sell-off since March of 20, right? So before a pandemic, and this thing has just been absolutely just blown out of proportion, destroyed. So a lot of people are putting a lot of money in bonds. I don't know. It's better to wait till they start cutting before, in my opinion, to start buying bonds again. But we'll see how that does play out. And now Tesla. It's got earnings again. Something I talk about when I talk about price action is Tesla is hardly moving. Tesla normally makes huge moves like this. See, before this earnings statement, it had a huge move. And then coming into this earnings, it's just been winding up. It's not saying Wednesday could be the day where this thing breaks and rips. So if it does end up breaking roughly, I think if it breaks that 276 and breaks out of this wedge, that could be a huge move up. Now, if it struggles, we get some bad news. You have to have really bad news during an earnings cycle to take the market down, is what I'm trying to say. So if the market is going down, that is a huge problem, that your baseline is not clicking on its normal cylinder. That's a different cycle, and you need to be very careful. October is normally a very bad month, especially towards the back half of October. You need to be very careful. And so again, watching this wedge to see which way this breaks. But if it does break up, it could get a huge pump up to 400. I don't know. So that's something I want to watch. But again, if it does break down below roughly around here, probably say about 225, breaks retest, this thing could start being heading lower again to 150, to these different essentially levels here that I got marked in white. are kind of levels I'm watching there. Palantir, again, still holding very solid this roughly that 14 to that 20 mark. So again, the earnings isn't until November 2nd. So we got a while before this does play out. We'll see if we can get some pulling back. Definitely these key levels here, 14, 12, 10 are levels I'm looking to buy if this thing dips lower. But again, it's gotten a lot of big key contracts that are great, that I think it's going to get another positive earnings, which can essentially get it into the SPX. So that would be most interesting if it did. And then once that happens, again, institutions are going to come in and start buying it if it gets included in the essentially the SPX 500. So that will be interesting to watch to see what plays out there. BA, again, it's broken support and continuing to sell. Value is getting weak, is what that means. So definitely not a good sign. It'll lead to the downward sell pressure on that case. So kind of watching to see what BA does there. Needs to reclaim that 192. Again, it's held it for so long. The fact it's actually starting to sell off means we are seeing some weakness there. JPM did very well, but again, wick down. We'll see if this thing can recover. The top half, I'm watching that 170, but if it can't hold, essentially this 140, that could be a problem. Golden Sachs, look at the break below the wedge. It's looking weak. It needs to hold the 305. If it breaks that, could be a huge problem there. Bank of America, again, broke support here at the $27 mark and is trying to hold it. We'll see if it can hold. But again, you get some big banks going on this week. You got a lot of big information going on. So we're in a very interesting state going into this week. We're going to get more information. Expect volatility. Now is the time when the market is going to move. This is what the market is waiting for to dictate which direction it's going to go. So just keep all that in mind. Risk management is huge. Don't overexpose yourself, especially in this market. There's still way too much uncertainty, and we deal with probabilities here. The probability of the market heading much lower is very high, I think, in my opinion, still, until we have that bigger event and price in a recession. Will I feel comfortable going back to the upside with heavier risk at that point? So with all that being said, I appreciate you for watching this far. Go ahead and drop a like, and until the next one, I'll see you guys later.